Why tax planning is crucial for retirees in 2025. Tax planning is more important than ever for retirees in 2025. Rising living costs and potential changes in tax laws can quickly erode your hard-earned retirement savings if you're not prepared. Without a solid tax plan, you might end up paying more taxes than necessary, leaving you with less to cover essential expenses. For those aged 50 and above, smart tax strategies like Roth Conversions, managing required minimum distributions, and optimizing Social Security can make a big difference in keeping your income steady. Taking proactive steps now ensures a smoother retirement ahead. Next, let's explore how tax brackets apply to different types of retirement income. Understanding tax brackets and retirement income. When it comes to retirement income, tax brackets play a big role in how much retirees owe. Different types of income are taxed differently. Pensions, for example, are usually considered fully taxable, meaning the entire amount gets taxed based on the retiree's income bracket. Withdrawals from traditional 401ks and IRAs work the same way. Since contributions were made tax-free, the money coming out is taxed as regular income. This means larger withdrawals can push retirees into higher tax brackets, increasing their overall tax burden. Social Security benefits are a bit more complicated. Depending on your total income, up to 85% of Social Security benefits may be taxable. The exact amount depends on what the IRS calls your combined income, which includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits. If this total is over certain thresholds, a portion of your benefits becomes taxable. On the other hand, Roth IRA withdrawals are not taxable, as contributions were made with after-tax money. This can be a powerful tool for minimizing taxable income, especially in retirement. Retirees might also consider reducing their taxable income by spreading out withdrawals from their retirement accounts, instead of taking large lump sums. Tax laws may change in 2025, potentially affecting the tax rates or income thresholds for retirees. It's important to stay updated on these changes and adjust withdrawal strategies accordingly. A smart approach is to consult a financial planner who can help you structure your income to stay within lower tax brackets. This leads us to the next topic: how retirees can use tax-deferred accounts wisely to further manage their tax burden. Leveraging tax-deferred accounts wisely. Tax-deferred accounts, like 4.0, 1K, and traditional IRAs, offer clear benefits for retirees. The biggest advantage is that you can grow your investments without paying taxes on them until you start withdrawing the money. This allows your savings to compound over time, building up more value. However, the downside is that once you begin taking withdrawals, they're taxed as regular income, and taking out too much in a single year could push you into a higher tax bracket. To minimize taxes, it's crucial to be strategic about when and how you withdraw from these accounts. The timing of withdrawals is especially important in the early years of retirement. Many retirees make the mistake of taking large lump sums, which can increase their taxable income significantly. Instead, a smarter approach is to spread out withdrawals over several years, keeping your income within lower tax brackets. This not only reduces your tax bill, but can also help avoid triggering higher taxes on Social Security benefits. Another important consideration is the age at which you start withdrawing. Required minimum distributions, RMDs, begin at age 73, which means you must start taking money out, whether you need it or not. If you wait until then, large RMDs could push your tax burden higher. By withdrawing smaller amounts earlier, you can manage this more effectively. Now, while tax-deferred accounts can be useful, there's also a way to reduce your taxable income later in retirement. That's where Roth Conversions come into play. Roth Conversions. Is it worth it in 2025? A Roth conversion is the process of transferring money from a tax-deferred account, like a traditional 401k or IRA, into a Roth IRA. While this move comes with an immediate tax hit, since the money you're converting is treated as taxable income, it offers significant long-term benefits. The biggest advantage is that once your money is in a Roth IRA, it grows tax-free, and withdrawals in retirement are not taxed. This can be a smart strategy if you expect your tax rate to be higher later in retirement, or if you want to avoid large required minimum distributions, RMDs, that could push you into a higher tax bracket. In 2025, with potential tax law changes on the horizon, it could be even more beneficial to consider a Roth conversion. Locking in your tax rate now may help you avoid potentially higher taxes in the future. Additionally, the flexibility that comes with Roth IRAs, no RMDs and tax-free withdrawals, can provide more control over your retirement income. However, the upfront tax cost can be significant, so it's important to calculate carefully and plan the timing of the conversion. Some retirees choose to do partial conversions over several years to spread out the tax impact. For those looking to minimize their tax burden even further, charitable giving strategies can offer additional ways to reduce taxable income. Making the most of charitable giving. Charitable giving can be a meaningful way for retirees to reduce their taxable income while supporting causes they care about. One powerful strategy is a qualified charitable distribution, QCD. With a QCD, retirees who are at least 70.5 years old can donate directly from their IRA to a qualified charity. The beauty of this strategy is that the donated amount, up to $100,000 per year, is excluded from taxable income. This can be especially helpful if you're looking to lower your tax burden and satisfy your required minimum distribution, RMD, at the same time, without adding to your taxable income. Another option is using a donor-advised fund, DAF. A DAF allows retirees to make a charitable donation, take the tax deduction in the same year, and then distribute the funds to charities over time. This flexibility gives you more control over your charitable giving and can help spread out the impact of larger donations. Plus, you get an immediate tax deduction when contributing to the DAF, which can be useful if you're looking to reduce your taxable income in a particular year. Both QCDs and DAFs provide opportunities to give back while managing your taxes effectively. Now that we've explored these strategies, it's important to understand how required minimum distributions, RMDs, fit into the overall tax planning picture for retirees. Understanding required minimum distributions, RMDs. Required minimum distributions, or RMDs, are mandatory withdrawals that retirees must start taking from their tax-deferred retirement accounts, such as traditional IRAs and 401ks, once they reach age 73. The IRS requires these withdrawals because the money in these accounts hasn't been taxed yet. The amount you must withdraw each year is calculated based on your account balance and life expectancy, and it is taxed as regular income. For many retirees, RMDs can increase their taxable income significantly, potentially pushing them into a higher tax bracket. To manage or reduce this impact, one strategy is to start withdrawing from your retirement accounts earlier, before you hit 73, to spread out your income over more years. This can help you avoid large RMDs later on. Another option is to convert some of your traditional IRA or 401k funds into a Roth IRA before you reach RMD age. Roth IRAs do not have RMDs, and withdrawals from them are tax-free, which can give you more control over your taxable income in retirement. Planning for RMDs is crucial to managing your overall tax burden. By thinking ahead, you can use strategies like delaying withdrawals or doing partial Roth conversions to keep your income and taxes under control. Now, let's look at how retirees can further minimize taxes by maximizing deductions and credits in retirement. Maximizing deductions and credits in retirement. Retirees can lower their taxable income by taking advantage of deductions and tax credits. The two main options for deductions are the standard deduction and itemized deductions. Most retirees opt for the standard deduction because it's simpler and often more beneficial. In 2025, seniors aged 65 and older receive a higher standard deduction, which can help reduce taxable income significantly. However, if your medical expenses, charitable donations, and other eligible costs add up to more than the standard deduction, it may be worth itemizing. Medical expenses are one area where retirees can often benefit from itemizing. If your total medical costs exceed 7.5% of your adjusted gross income, the excess amount can be deducted, reducing your taxable income. On top of deductions, retirees may also qualify for tax credits, which directly reduce the amount of taxes owed. The credit for the elderly or disabled is one example, offering financial relief to eligible seniors with lower incomes. Tax credits are often more powerful than deductions because they cut taxes dollar for dollar. Using both deductions and credits wisely can make a big difference when it comes to tax season. It's all about finding the right balance based on your personal situation. Next, we'll take a closer look at how Social Security benefits are taxed and what retirees can do to minimize their tax exposure. Social Security taxation: how to keep more of your benefits. Social Security benefits can be taxed depending on your overall income. The IRS uses a formula called combined income to determine how much of your benefits are taxable. Combined income includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits. If your combined income exceeds certain thresholds, $25,000 for single filers and $32,000 for married couples filing jointly, up to 85% of your benefits may be taxed. To minimize the amount of your Social Security that gets taxed, one strategy is to delay claiming benefits. By waiting until full retirement age or even later, you can reduce your taxable income early on and allow your Social Security benefits to grow. Another strategy is to manage withdrawals from other retirement accounts like IRAs and 401ks so that they don't push you into a higher tax bracket. By being strategic with the timing of your withdrawals, you can keep your income within limits that help reduce the tax hit on your benefits. For many retirees, careful planning can make a big difference in how much of their Social Security is taxed. It's all about balancing your income sources and considering how withdrawals, pensions, and other factors will affect your taxes. Now that we've covered Social Security taxation, let's move into estate planning and how to handle inheritance taxes to protect your legacy. Estate planning and inheritance taxes. Estate planning is crucial for retirees who want to minimize the tax burden on the assets they plan to pass on to their heirs. Without proper planning, a portion of your estate could be subject to federal estate taxes, reducing the amount your beneficiaries receive. Fortunately, the federal estate tax exemption is quite high, over $12 million per individual in 2025. So most retirees won't need to worry about paying federal estate taxes. However, if your estate exceeds this amount, you'll want to explore strategies to reduce the taxable value of your estate. One simple strategy is tax-free gifting. You can give up to $17,000 per year per recipient without it being subject to gift tax. Over time, this can significantly reduce the size of your taxable estate, helping you transfer wealth to your heirs while you're still alive. Setting up a trust can also provide tax benefits and more control over how your assets are distributed. With these strategies, retirees can protect more of their estate from taxes, ensuring their loved ones benefit fully. Next, let's explore tax-efficient investment strategies that can help retirees manage their portfolios and keep more of their earnings. Tax-efficient investment strategies. Tax-efficient investment strategies can help retirees reduce their tax burden while maximizing returns. One option is investing in municipal bonds, which provide tax-free income at the federal level and sometimes at the state and local levels, depending on where you live. These bonds are particularly attractive for retirees looking to preserve capital while minimizing taxes on their interest income. Managing capital gains taxes is another key strategy. By strategically timing the sale of investments, you can control when gains are realized and avoid pushing yourself into a higher tax bracket. For example, you can sell investments during years when your income is lower to benefit from lower capital gains tax rates. You can also offset gains by selling investments at a loss, known as tax loss harvesting, to further reduce your taxable income. Diversifying your investments across different tax treatments, like a mix of tax-deferred, tax-free, and taxable accounts, helps create a tax-optimized portfolio that gives you more control over how and when you pay taxes. This balance can make a significant difference over the long term. Now that we've covered investment strategies, let's dive into tax-optimized withdrawal strategies that retirees can use to make the most of their retirement savings. Tax-optimized withdrawal strategy. Putting it all together. A tax-optimized withdrawal strategy helps retirees maximize their savings while minimizing taxes. The general rule of thumb is to withdraw from taxable accounts first, then tax-deferred accounts, and finally tax-free accounts, like Roth IRAs. Starting with taxable accounts allows your tax-deferred investments to keep growing while minimizing the immediate tax impact. When pulling from taxable accounts, you'll only pay taxes on capital gains, which are often taxed at lower rates than regular income. Once you've used up your taxable accounts, you can begin taking withdrawals from tax-deferred accounts like traditional IRAs or 401ks. These withdrawals are taxed as regular income, so it's important to plan carefully. Taking out too much in a single year could push you into a higher tax bracket. This is why spreading out withdrawals over time can help keep your tax rate lower. Finally, tax-free accounts like Roth IRAs should be tapped last. Since Roth withdrawals aren't taxed, you can rely on them later in retirement without worrying about increasing your tax burden. Adjusting this strategy yearly based on changes in tax laws and personal circumstances is crucial for staying efficient and minimizing taxes over time. As you can see, a smart withdrawal strategy can make a big difference. Consulting a tax professional ensures that your plan is tailored to your specific situation, which we'll cover next. Consulting a tax professional. Consulting a tax professional is a smart move for retirees looking to optimize their tax strategies for 2025. Tax laws can be complex, and personalized tax planning ensures that your strategies are tailored to your unique financial situation. A tax advisor can help you balance withdrawals, minimize taxes on Social Security, and adjust your plan as laws change. Key questions to ask include, how can I minimize RMD taxes? And should I consider a Roth conversion? With expert guidance, you can make informed decisions and protect your retirement income. Now let's bring everything together in our final conclusion. Keeping more of your money in 2025. To recap, we've covered several key tax strategies for retirees in 2025, including Roth conversions to reduce future taxes, managing required minimum distributions, RMDs, using charitable giving to lower taxable income, and optimizing Social Security benefits. By acting early in the year, retirees can take full advantage of these strategies to minimize their tax burden and protect their retirement savings. Smart tax planning not only reduces taxes, but also ensures a more secure financial future. Start planning now to make the most of these opportunities and keep more of your hard-earned money in retirement.